Hey guys, thanks for tuning in. Before we get started in today's video, don't forget to join our free Facebook community, get real answers to real credit questions, learn from some of the experts in our industry, as well as from other people that are in similar situations that are taking advantage of the free content and improving their credit and making their credit situation better. Hope to see you guys on the inside.
Debt settlement versus debt management. Welcome to the Credit Agents Talk Show. Credit card debt can definitely get out of hand with interest rates between 19% all the way up to 29%. Sometimes it can make it super hard to pay off, especially when someone falls into the credit card trap and max out their credit cards and only pay the minimum. It can make it very difficult to get out of this trap. Today, we're going to discuss two options to help you get out of debt. I'm Lesley, and welcome back to the Credit Agents Talk Show. Debt management programs are typically offered by consumer credit counseling services. These nonprofit organizations are accredited and monitored. They work with creditors to get a reduced interest rate, which would make it faster for you to pay off. In exchange, clients will pay back 100% of what they owe over a fixed amount of time. Let's talk about a few pros. One monthly payment is going to be made to the agency, and the agency will disperse the payment to the creditors. This is going to help you save money on interest rates and also preserve your payment history portion of your credit score. You could see a slight score drop due to reduction of credit that is available. Each account that is paid by the consumer credit counseling services will typically have a comment on the credit report that says account paid by third party. And this sometimes makes it look like you're seeking help to pay off these accounts. Now let's talk about debt settlement. Typically, these are for-profit companies, and they are more regulated and monitored now than before. A consumer usually ends up paying about 40% of the total debt plus a 10 to 15% agency fee, which comes out to about 40 to 45% savings. Now let's talk about debt settlement pros. This is going to help save you a lot of money in the end. It helps avoid bankruptcy, and also it helps you get out of debt quicker. Let's talk about what the cons look like. Now, this is going to give you a risk on some of the larger debts of lawsuits. Now, if you are current on all of your credit cards before going into a debt settlement program, your payment history once you go in is going to be wrecked. Debt collectors generally will issue a 1099 form on forgiven debt. That's it for today. Thank you for joining us, and I'll see you next time.
After these messages, we'll be right back.
So I heard that you guys do disputes. I was hoping you could tell me a little bit more about that. Yeah, so when it comes to disputing, you're going to be sending your letter to maybe all or one of the three major credit bureaus. And these bureaus themselves will use an automated system called eOscar to filter out dispute letters because they get a lot of those letters. Now, what we here at the Credit Agents do is we know how to get past this automated system so that your letter can get into the right hands. Gotcha. Okay, so will I be along with you for this process, or how exactly does this work? So we're actually going to take care of all of that for you, and the only thing you're going to have to worry about is letting us look at your credit report. After that, we have a good idea of what we should dispute and can dispute, and we'll take care of talking to all of the credit bureaus on your behalf. And you'll only have to pay once we get deletions made off your account, as per our pay-per-deletion program. Awesome. Well, I'm so happy I chose you guys, the credit agents, to help out with these disputes, making it such a simple process.
Now back to the show.
Welcome back to the Credit Agents Talk Show. Today we're going to be talking about, can I get a mortgage if my spouse has bad credit? The housing market is crazy right now. Home prices are rising and rates are still at an all-time low. But can a spouse's credit hold up, possibly getting pre-approved on a house? I'm Lesley, and this is the Credit Agent Show. Generally, no, but it's going to depend on the loan type. Generally, a 580 to a 620 FICO score is needed in order to qualify for most type of loans. Now, to have both incomes considered, both applicants must pass the initial credit pull. That means if a spouse's credit falls below the requirement, their income cannot be considered and they cannot be on the loan. Now, if your spouse isn't working or doesn't have an income, that is totally okay. However, the primary person that is on the loan needs to have the minimum income requirements to support the whole household. So if the non-purchasing spouse has some credit challenges, no income, and a lot of debt, this could be problematic for a lot of loan scenarios. For government-backed loans like FHA, VA, USDA, a non-applying applicant's debt will still be considered with the debt-to-income ratio. So this means that debt does matter. Generally, these loans can go up to 57% debt to income. This means that the mortgage company doesn't want your monthly payment plus your monthly debt that you currently pay to exceed what you're able to afford. Mortgage companies look at the following debt: car payments, credit card minimums, 1% of student loan debt, and 5% of non-medical collection debt. A non-backed government loan, like conventional mortgage, can ignore the spouse's debt. And instead of a 1% student loan debt, if loans are in an IDR program, the lower monthly payment will be considered instead. Let's talk about some good options to help with DTI. Refinancing your auto loan is something great to consider and could save you a lot of money. Pay off all credit card debt. Put student loans in an IDR program. Settle and delete all non-medical collections that are over $1,000. And the last option and the best option is to call the credit agents. That's it for today. Thank you for joining us, and I'll see you next time.